Hi, my name is Adrian Helfert, CIO of Multi-Asset for Westwood. I appreciate you listening today. I just wanted to talk to you quickly about the market environment and just focus a little bit on bonds. The market environment is still a tough one. It's still driven by the central bank, the Federal Reserve, and whether they're going to be continuing to hike rates in the face of heightened inflation. It's driven by geopolitical risk, heightened by things that are happening in China as well, as we've seen very recently. At the same time, what this has done is that's risen bond yields very significantly. That means your proverbial 60-40 portfolio, your balanced portfolio that has 60% equities plus 40% bonds, has had an extraordinary sell-off. As bond yields have gone up, bond prices have gone down, at the same time as equity prices have gone down. So if you open your overall personal statement and you say, well, I've got the safe haven of bonds, it hasn't worked this year. It hasn't worked this year enough that this has been the largest drawdown in that style of portfolio since 2008. And it's on the realm of a 2 standard deviation move, a highly unlikely move. We think that's going to create an extraordinary opportunity. If you look in the past at what's happened, prior to 2022, the past 13 years were 16 to 16.5% plus returns on the S&P 500 on average and on median. That was in context of a bond market where yields were extraordinarily low. The Fed was keeping rates extraordinarily low. So that's great for your bonds, so your equities, but not so good for holding bonds that are giving you a 1% yield. And maybe the yields are going down, prices are going up some, but it's constrained. We're in a new environment now. The central bank has been raising rates, which has been pushing bond yields up. At the same time, that's been constraining the overall economic environment. It's going to put pressure on earnings, and we're seeing some of that already. And that means the forward expectation isn't 16.5% returns on your S&P 500 for the next several years. It's more of a normalized environment. So let's think about that balance for a second. On one hand, prior to 2022, we were looking at investment grade bond yields that were 3 to 4% in context of a 16% equity market. Today, we're looking at investment grade bond yields that are 6%, 7% in context of a normalized, maybe an 8 to 12% equity market longer term. That means the balance has shifted for where you can get returns. And at the same time, bonds, corporate bonds especially, have this asymmetric profile, which in a low yield environment, you don't have much buffer when prices go down. But in a higher yield environment, you have more of the yield buffer. So at the beginning of the year, let's take high yield bonds. The downside for high yield bonds, if rates go up and riskiness rises, is upwards of 17%. On that exact same metric on the other side, your upside is lower. It's around 8%. Today, that metric is different. You have that shield of 10% yield on a high yield bond. If they become more risky and rates rise, then you're down about 4%. On that same size metric on the other side, if things go well, you can be up about 16%. On a balance side, we think it is positioned for very good returns. We think investors should think about their bond allocation as a composure over all of their portfolio increasing, where you get higher yields and you have that positive skew to your portfolio. Thank you for listening. I hope to keep bringing you topics of interest. Please reach out if you have further questions.